What's going on, everybody? Welcome to How Stock Trades. All right, so I have a lot to say about this quarter. Okay, so let's see. Where do we start? First things first, everything in this video is for educational purposes only. We were going to go ahead and talk about what's happening right now with Clover Health. Now, immediately, as soon as I saw this, I was like, yeah, we're going to go down. That's for sure. It spiked up to like $3.04, $3.05. And I talked about it in the terminal and I said, yeah, guys, this is not going to stay up too long. This thing's going to go. And the reason being is that let me just try to exit all this here so we can. The reason being is that Clover Health, the second quarter profitability metrics was a GAAP net loss of $11 million, right? And the adjusted EBITDA, their EBITDA actually went down as well. So, and I don't even know why they have this adjusted net income, honestly. I don't understand why they're reporting both. Possibly, maybe they can shed some light on that. But, the adjusted EBITDA for Q2 2025, second quarter of 2025, was $17 million. And the reason why I am not happy with this is if you go to 2024's EBITDA, here and just, go, let's copy this here. Oh, here it is. Adjusted EBITDA Q2. It was actually $36 million, right? The adjusted EBITDA. So their adjusted EBITDA actually went down. It went from 36 million, right, down to 17 million. So it pretty much dropped in half. And the question is why? So I went through the slides really quickly. Again, the earnings just happened now. And I saw that the insurance BER, their prior guidance went from 87% low, and they increased it to 88.5%. And their 88% high is now increased to 89.5%. So they actually increased their essentially costs a lot higher than what they initially thought. Likewise, their adjusted SG&A surprisingly, it went down. So what does this mean to me? It tells me, by the way, their adjusted EBITDA, they're still saying it's going to be the same. So that'll be interesting to see how they're doing that. We got 25 in the first quarter. So we still got, then we got what? 25 plus 17 is 42. So let's say max, we got about 28 to play with. And they didn't increase the guidance like I have hoped for. And the reason being is the new members that they're taking in are unfortunately unprofitable, right? The new members are very unprofitable. So why? So the average MCR differential for the first year of taking in new members is actually really, it's not as good. So that is year one. But the second year, you get a 700 basis point differential. And then the next year, a 1,500 basis point differential. So they, from the Clover Assistant, it needs more time to cycle into that 37% growth that they're having right now. Likewise, next year, they're going to be paid 4 stars, which is going to give them an ample. So if they were paid 4 stars this year, then there would be a high probability, I would say at break even based off what I'm seeing, given how these members are unprofitable in the beginning. But really the next year with the 700 basis point differential based off of the slide there. So a couple things that I'm looking at also, this is the older earnings report. I'm going to just put this to the side. If I go all the way up here, we talked about this and we pretty much talked about all this other stuff. Again, Andrew, I don't really care about this COPD, um, in the earnings report, because one, it is important, but you talked about it yesterday in the earnings release. I would say this is just a filler, right? What I do like is what I can read here. Let's just read this together. This is from the document. Let me just go ahead here. And very quickly, let's take a look at the stock price now. The stock price now is $2.49, right? So when it was going up to $3, I was like, I don't understand what these people are doing. Maybe potentially day traders or something, or folks that don't understand the financial sheet. So if you go ahead and read this, well, first, before I give you the good news, let me talk about more bad news, because there's more bad news. So if you go to the cash flow statement, and if you go to the cash flow statement here, right there, we can see that the cash flow from operations is negative. It's negative 10 million, right? So we have negative 10 million of free cash flow for the 6-month end. So we're at negative 10 this year. And last year we were at 79. Now, again, the reason why we were positive last year was because of unpaid claims. Unpaid claims are $16 million. So negative, right? And what that means is they're paying their physicians faster, very fast, to where it's negative, right? So I have a speculation of why they're doing this, and I think it has to deal with them trying to essentially be able to pay out those claims to those physicians, can ultimately recommend Clover to other patients, and to hopefully potentially secure 4.5 stars for payment of 2027, I believe. So there's that. Okay. So let me think here. So again, free cash flow negative on the 6-month. Peter did say that they're going to be positive operationally this year, strong operations. And as of right now, I don't see that from this earnings report. And is this a change, given that it's going to be a short-term bump? But what they did is, for unpaid claims, they paid the physicians even more faster than what they normally do before. And that keeps the doctors happy. And I think that's what they're doing right now. Versus last year, they kept it. Okay. And I think they kept it, to help with potentially having more cash on hand. So there's that. Let's go ahead and review the stock price now. We're currently at $2.47. And so let's go back upwards here. So by the way, just very clear, let me be very clear. A lot of retail investors right now are selling. Okay. And this is unfortunate. This is unfortunate. A lot of retail investors are selling right now. Okay. And what's happening is there was a paper published by Wolf regarding United Healthcare and how they're expecting the Medicare Advantage market to come back online. If I was Wall Street right now, I definitely would want these retail investors to sell. We're going to see increased institutional ownership, sadly, in the next coming days. And a lot of institutions now are pretty much gobbling up all the shares of retail investors. It's unfortunate, but it is what it is, right? A lot of retail investors are most likely selling now. So with that, we are negative 10 million on Q1 and Q2 cumulatively. The stock terminal will be able to parcelate this and we'll be able to figure out what we were this year. If we're negative 10 million now and we were negative 6, what were we this year? I'm trying to figure it out. What were we in first quarter before the earnings call starts? What was the first quarter's cash flow here? There. The first quarter's cash flow was negative 16 million. This was the first quarter's cash flow. So that means that this year we were free. That means that Q2 was free cash flow positive. So how do you do that? Well, you go here and you say negative. Okay. And then we ended up going from this to this, which was, and a lot of retail investors don't know how to read these and interpret these. And I'm buying right now, right? It's again, this is it is what it is. People don't know how to read this stuff, but I'm definitely a buyer, and because of now I'm going to say the good news, right? Again, not financial advice. This is just from educational and what I'm doing, right? So they went from this to this. They went from a less negative number. So we could go and plug this in ChatGPT. You can say, so how much did they gain? So that means Clover Health was free cash flow positive of $5.4 million this quarter. Okay. So $5.4 million. So I'm going to just go ahead and I'm going to post this here. CLOV Q2 2025 FCF positive 5.4, and the stock terminal will do this math automatically the way I programmed it. 5.408 million. We'll just go like this. Okay. Go ahead and quote this. Okay. All right. So there's that. Okay. So they're actually free cash flow positive this quarter. I know it says negative here, but this is 6-month end. This is the 6-month end. So to find the difference, you take Q1 and the difference between Q2 6-month end to find that they were actually FCF positive. Okay. Let's update this here. Okay. So that's semi good news. Again, I was hoping for more, but I get it. They're returning to growth, and then so now the question is, what's next, right? So going up here, this is what they said. Our performance further demonstrates how our technology-first model drives better care management, above market growth, and sustained profitability, said Andrew Toy. By leading with affordability and choice, the AI-driven clinical recommendations, we have achieved strong MA results this year, and importantly, better health outcomes for our members. Our recently published clinical white paper on COPD. Okay, no, I already read this. This is not, I'm sorry. This is fluff. I don't know why I have that highlighted. I meant to highlight this. Is there a way to unhighlight? Okay, I can't highlight. That's fine. I meant to highlight this. So let me highlight this. So let me read this. Okay, so our second quarter 2025 results reflect significant membership and revenue growth alongside with sustained adjusted net income and adjusted EBITDA profitability. We are excited. We are executing our growth strategy well and have generated significant momentum in our business this year with 3.5-star payment. We believe this positions us well to achieve our updated 2025 guidance, right? And expect it to further accelerate our growth and profitability in 2026, which is 4-star payment. So what does that mean? Right? Because they're talking about a EBITDA profitability. What growth and profitability in 20? Are we talking about real profitability? Are you going to be profitable this year? Sorry, in 20 this year, I don't believe they're going to be profitable. But are you going to be profitable in 2026 with the 4-star payments? Because that's exactly what we're gearing up against, right? So that's another set of good news. The other one that I'm looking at, going back to the cash flow statement, is we just said, and again, not a lot of people know how to look at these things, right? We just said that they're actually free cash flow positive this quarter by about whatever it was, $5 million, right? So about 5.4 million. Now, if you go to the stock terminal and type in CLOV and go to the quarterly and go to free cash flow, last year they were $44 million, $44.36 million of free cash flow. Now, I'm trying to think. What I would like to do is actually show you a different calculation because it's just, and maybe some of you will understand this. Okay, so this is quarter number 1. Let's go to quarter number 2. So this is the most recent quarter that they updated, okay? Here's the net cash from operations, okay? From just the surface level view, you can see that they went from 79 million of positive operational cash flow to 10.8 million negative. This is the 6-month end. So 6 months into last year's 2024, they were up 79 million. 6 months into 2025, they're down 10 million. And that's because last Q1, they were down 16 million. And this Q2, they're up 5.4 million, which is why it went from negative 16, which you can see here. It went from negative 16 from the first quarter of 2025 to negative 10. And negative 10 is a less negative number. It goes back to algebra. So now let's do some more math. You see unpaid claims here? It's negative 16. Okay? It's negative. Usually it should be 0, okay? Or above 19 or 20, right? Last year, at the end of the year, it was around 20. But if you compare it to the 6-month end, last year it was positive $63 million. Okay? So if we were to do some math right now, and if we take this 63.4 million, okay, subtracted from the 79 million.
79,697.
If you subtract these, you get $16.2 million of technical free operational cash flow, subtracted from the discontinued operations, which we don't have anymore. But we could just say 79.6 million subtracted from 63.4 million. And if we do that, let's see if we can add a text box here. It's 16.25 million. So that whoops. So if we remove unpaid claims and assume that last year they paid all of their claims out, we should be at 16.25 million last year, assuming that if they wanted to pay the doctors early last year. They did not. They did not want to pay the doctors early last year. Perhaps because they wanted to potentially do the stock buyback, who knows, right? So if we adjust for that and say, let's say they paid all their claims, technically Q2 last year, both Q1 and Q2, were at 16.25 million. Now, for this quarter, assuming that we take unpaid claims now and we bring it up to zero because they're paying a claims ahead of the time, now we take negative 10.885 million and we add it to 16.736 million. That brings us about 5.8 million Let's go add the text here. Of operational cash flow. Again, which is why I'm still not happy, a lot lower than what we might assume. Now, of course, you add that extra 5% bonus for the 4 stars. You add that extra 10% bonus, right, for the CMS new rate count. Then, of course, you're going to get a higher number next year. But how high is it going to be? Because what happens if these new members that they're getting in next year are going to be more unprofitable? Okay. So there's cash from operating activities. Now, if you look at cash from investing activities, I got to delete all this. They went from 14 million. I got to click this. I don't know how to use Adobe. They went from $14 million to $44 million. So their cash from investing activities actually went up. So I'm curious to see what's their cash and cash equivalents. So their cash and cash equivalents went from 188 million. And if you look at last quarter's cash and cash, that's what I'm saying. Like, we're going to keep getting deeper and deeper. Their cash and cash equivalents here, it used to be 155 million. So from their investments, they actually increased 100. So we have to take these numbers and subtract it from this one. So that gives you $33.2 million increase in Q2 of 2025. I remember I have to click this, right? So there's that. So this is what they did. That's increase. Okay. So essentially, and I don't know why it's not showing the comments here. I'm so sorry. I'm showing the comments now. My apologies here. Now let me see the comments. There it is. Now you guys can see the comments on the things here. Okay, so now that we see this, see the comments now. Sorry about that, guys. You could see that they actually made $33.2 million this quarter in terms of operations from not this quarter, but the past 2 quarters. And you could see that from cash from again, people don't know how to read these things. Okay, that's why financial education is important. So you could see here from net cash from providing investing activities, they went from 44 million to 14 million. So they actually increased the amount of cash from their based off of their security sales, right? So they made money, which then increased their cash reserves from 155 million to 188 million. So now they have more cash than what they did last quarter. If you look at total assets went from 583 million to 574 million. They went down. Total liabilities went from 200. Total liabilities went from 247 million to 230 million. So the liabilities went down, which is good. Excellent. Okay, good. We want liabilities to go down. Now, in terms of total stockholders' equity, this is the unfortunate part. Because if your net income, it goes down, but because their investing activities went up, they went from 336 million of total stockholders' equity to 344 million, a difference of approximately minus 36 of $8 million. So actually, the share count, when the book value actually went up this quarter. So that's pretty good. The book value actually went up. Okay. And again, this goes really heavy into the analysis. Not a lot of retail investors understand. So, which is why it's a good. I'm a buyer. You're starting to see some consolidation now. People are realizing, but there's a lot of people that sold. In fact, I'm in another group right now, and I'm seeing other people. They're commenting, not the Al Stock Trades platform, but other people are saying, "I sold. I'm out. I can't take this anymore. I'm out of here," and they're selling. And this is exactly what retail want. This is exactly what institutional investors want. Okay, now before, because they're going to buy your shares, right? Like I told you. How do you think institutional ownership has been increasing, right? It's a sad thing to see, but it is what it is. Okay, so then now let's go ahead and now let's calculate MCR, because the company doesn't give Meta MCR anymore, and I want to know MCR. Okay, so all right, so to do that, before we get into the earnings call, I'm scrolling, trying to figure out. Okay, so yeah, this is obviously the difference between 7.4 million positive this year. And so let's figure out kind of what happened. So they made 469 million versus 349. Other income was 7.7 million versus 6.3. Total revenue was 477 versus 356. Net claims was 377 versus 248. And then let's see. So to calculate this, we take the premiums earned which is this number here. This is premiums earned. And then we divide it by medical claims, which is right here. Medical claims.
377,992.
So when we do that, there it is. We get an MCR of 80%. So it's still industry leading. They still have industry leading MCR, even with this jump. So the MCR now, because they don't give MCR anymore. You have to calculate it. So the Q2 2025 MCR is 80%. There it is there. Q1 2025 MCR. So let's go to Q1 2025 MCR. Let's see here. I'll just go premiums earned. Just go like this. It's a lot faster. There it is. So you take this here,
456,906.
and then we go into net claims incurred.
353,442.
So last quarter,
0.7735.
their MCR was 77.3%. Okay. Now, if we compare last Q2, we don't really have to do that because that's the 3-month June. We could do the 6-month end, which will be interesting. But this quarter's MCR jumped by 3% from, let me look at it. For 77, yeah, it jumped pretty much by 3%, 78, 79, 80. So, yeah, so cost definitely went up this quarter. That's why they weren't expecting costs to go up this much. So we'll continue this. We're going to go ahead and look at the call right now. So let me go ahead and pull the call up. Clover Health Investor Relations. Let's open up the call. Okay. Yeah, as you can see, guys, I don't. It's the call is still not. Okay, they just started. All right, go ahead and.
Call. At this time,
You guys hear it?
participants are in a listen-only mode. A question and answer session will follow the prepared remarks. At that time, if you would like to ask a question, please press *1 on your telephone keypad. As a reminder, today's call is being recorded. I would now like to turn the call over to Ryan Schmidt, Investor Relations for Clover Health. Please go ahead.
Good afternoon, everyone. Joining me on our call today to discuss the company's second quarter 2025 results are Andrew Toy, Clover Health's Chief Executive Officer, and Peter Kuipers, the company's Chief Financial Officer. You can find today's press release and the accompanying supplemental slides, as well as the company's most recent investor deck in the Investor Events and Presentation section of our website at investors.cloverhealth.com. This webcast is being recorded and a replay will be available in the Investor Relations section of the Clover Health website. I'd also like to caution you that we may make forward-looking statements during today's call, that are subject to risks and uncertainties, including expectations about future performance. Factors that may cause actual results to differ materially from expectations are detailed in our SEC filings, including in the Risk Factors section of our most recent annual report on Form 10-K and other SEC filings. Information about non-GAAP financial measures referenced, including a reconciliation of those measures to GAAP measures, can be found in the earnings materials available on our website. With that, I'll now turn the call over to Andrew.
Thank you, Ryan. Welcome, everyone, to our second quarter earnings call. We are happy to report that we delivered yet another impactful quarter this year, building our momentum and demonstrating our ability to achieve meaningful growth alongside sustained adjusted EBITDA profitability in Medicare Advantage through the first half of the year. To start, I feel we are executing well against our strategy. We have always aimed to position Clover to win over the long term within Medicare Advantage, and our arc has been simple. First, achieve profitability, then return to growth while sustaining profitability, and then leverage our differentiated model to accelerate growth and profitability together. We exceeded our adjusted EBITDA profitability target in 2024. Through the first half of 2025, we are executing well and believe that we are proving that we can achieve sustained adjusted EBITDA profitability amidst meaningful membership and revenue growth, all during a 3.5-star payment year. And most importantly, we expect that our performance in 2025 will position us very well to accelerate both growth and profitability in 2026, which is a 4-star payment year, and where we will continue to offer our flagship wide network PPO plan while others retreat from that offering. Our trajectory is clear. We are confident in the path ahead, and while not all market plan data is available yet, we have reason to believe this will be another strong membership growth season for us, potentially even stronger than this year. Also, with next year being a 4-star payment year, we feel we should be able to strongly grow 2026 adjusted EBITDA as well. Next, let's discuss how our second quarter highlights our strategic arc and the significant value our technology-first care model brings to our members. As I mentioned, we're continuing to deliver robust membership and revenue growth this year, alongside sustained adjusted EBITDA profitability in our business. Since last quarter, our Medicare Advantage book has continued to increase membership, and we are now projecting ending 2025 with even more members. This is not just growth for growth's sake. We're making a real difference by bringing earlier care management via Clover Assistant technology to more and more Medicare Advantage seniors. We're, of course, proud of our financial results so far this year, and I believe we have truly differentiated ourselves through the unmatched value we bring to our members. We continue to lead with physician choice, affordability, and high-quality healthcare through our technology-first care model, and we are driving real-life results. And this, ultimately, is driving our growth, and we believe is why seniors are choosing Clover Medicare Advantage plans. As another example of our model's impact, earlier this month, we published a clinical white paper on chronic obstructive pulmonary disease, or COPD, showing that a relationship with a Clover Assistant provider was correlated with 15% fewer hospitalizations and 18% fewer readmissions. Our results are more than just numbers on a page. They're a testament to the momentum we're building and the effectiveness of Clover Assistant to make a real-world impact in better managing chronic diseases. Next, I would like to discuss broader industry managed care trends, particularly in the context of the pressures others are noting in the Medicaid and ACA markets. It's crucial to note that at Clover, our business is Medicare Advantage. We do not run standalone Medicaid plans, nor do we participate on the ACA exchanges. We do serve dual eligible members, but these Medicare Advantage individuals are, by definition, seniors or are disabled, meaning that they are not impacted by dynamics like work requirements, within the construct of Medicaid redeterminations. As such, we believe that our Medicare Advantage focus should help insulate us from these broader industry pressures. However, we are also seeing some of the elevated cost trends within our MA book that others in the industry have identified. That said, we are generally satisfied with the underlying trends we're observing in our portfolio. I would note that we are keeping a particularly close watch on the impacts from the Part D IRA changes this year. Given that this is the first year of the new program, there is less of a historic baseline to trend against, and so we anticipate more variability in our modeling of performance. As such, we are diligently monitoring this to see how it plays out through the remainder of the year. Put another way, while I think we are appropriately focused on delivering our care management model, we also recognize that Part D remains a big known unknown for the second half of the year. This is also consistent with the recently published Part D direct subsidy rate, which is materially higher for 2026 than for 2025, signaling higher costs than expected by the industry. The good news is that this also gives us reason to believe that Part D pressure in 2025 might be alleviated in 2026. With all that said, against this backdrop of general managed care headwinds, we continue to believe our technology-centric care delivery model differentiates us. Remember that our approach to managing total cost of care is fundamentally different. It's anchored on identifying and managing diseases as early as possible via Clover Assistant and simultaneously delivering crucial support through our Clover Care Services offering when and where our members need it most. This unique approach allows us the potential to truly bend the cost curve over time for our members and effectively manage trends amidst broader industry pressures. To that end, we're extremely excited about the new health tech ecosystem initiative unveiled last week by CMS and the White House that focuses on building a truly patient-centric, interoperable ecosystem. This initiative, fostering a smarter, more secure, and personalized healthcare experience through enhanced interoperability and real-time information sharing, resonates deeply with the foundational principles we've championed at Clover since day one. Clover Assistant is already built upon the very interoperability framework and FHIR standards highlighted last week, both utilizing data to generate actionable insights and contributing those insights back into the networks. Ultimately, Clover Assistant and AI technologies all scale with data. And we see this initiative as turbocharging data access, which will then bring a significant accelerant to our technology approach. Looking to 2026, we anticipate building on our successful 2025 strategy with an even sharper focus on profitable growth in our bids. Our commitment to expanding Clover Assistant's reach, emphasizing retention in existing markets, and balancing new and returning member cohorts remains central to accelerating our growth strategy. While the competitive MA landscape will undoubtedly evolve, we're confident in our pricing and positioning next year during a 4-star payment year, as we've already proven we can deliver strong MA performance during a 3.5-star payment year in 2025. This step up in our stars rating provides us with an additional financial tailwind in 2026, and we believe that this will also position us to continue to strengthen our insurance product. We're proud of the growth and momentum we've achieved in our results so far this year and look forward to our flywheel starting to spin much faster as we go into 2026. Now, let's discuss our Counterpart Health progress and overall strategy. Since we announced last year that we made our same CA technology platform available to other risk-bearing entities, we've seen broad interest and uptake. Our belief is that everything in healthcare ultimately revolves around the health outcomes and total cost of care of a patient. Involved in delivering these outcomes are a number of healthcare ecosystem players: primary care physicians, risk-bearing ACOs, pharmacies, large hospitals, and of course, health insurers, both regional and national. Counterpart Assistant can benefit all these third parties, and the interest we've received through the deals we've already announced shows the varied application potential of the tool, both by scaling CA within our own plan and outside of it. In particular, we are seeing a lot of resonance with plans that need assistance with star ratings and HEDIS quality scores, as well as managing costs within their PPO-wide networks. Based on this, we are very excited to have pipeline deals and deployments across the healthcare ecosystem. As a reminder, while we aren't able to announce every customer, we have announced several large health system deals, and we're very pleased with our progress with payer partners. Our MA plan also recently announced a pilot to use CA with independent pharmacies, bringing our technology to yet another, often overlooked, site of care. I'm excited about our progress, and I believe we are well on our way to showing that Counterpart Assistant is capable of powering Medicare Advantage, not just in our own plan, but in any managed care setting, nationwide, and that it's ready for prime time scale. In summary, we are focused on achieving our goals this year and are strategically positioning the company for the future. We're growing significantly, operating profitably, and differentiating ourselves through our technology-first model. Simultaneously, we are setting the stage for an even more impactful 2026, which we believe will cement our position as a leader in Medicare Advantage. Now, I'll hand it over to Peter for a more detailed financial update.
Thank you, Andrew. Before we get to the financials, I want to emphasize our strong position in today's managed care environment. We are demonstrating great Medicare Advantage execution, leading with a wide network PPO plan that currently serves 97% of our members. We have achieved over 30% membership growth, which is well above the industry, all while maintaining profitability on a 3.5-star payment year. We have outlined our year-over-year profitability drivers on page 8 of the earnings deck posted to our IR website. We are absorbing typical new member growth headwinds through the strong economics of our returning cohorts. And while our variable and growth SG&A cost is increasing due to this strong growth, coupled with our strategic investments into our model, this is effectively balanced by ongoing cost efficiencies in our business, a topic I'll elaborate on later. Now, diving into the financials. Our results reflect continued growth and momentum in Medicare Advantage with sustained adjusted EBITDA profitability through the first half of 2025. We've grown both membership and revenue by more than 30% year over year, and at the same time, we improved GAAP net loss from continuing operations by $4 million to $12 million, and maintained our year-to-date adjusted EBITDA and adjusted net income steady at $43 million and $42 million, respectively. Our results, powered by our technology-first model of care, reinforce our confidence in achieving our updated full-year 2025 guidance. We believe this also positions us well for accelerated growth and a meaningful increase in profitability in 2026, which is a 4-star payment year. Now, let's move to a more detailed review of our second quarter financial performance, drivers, and our updated full-year 2025 guidance. Clover's core fundamentals are strong, with well above market insurance revenue and membership growth. Second quarter 2025, Medicare Advantage membership grew 32% year over year to above 106,000 members. This growth fueled a 34% increase in insurance revenue to $470 million in the second quarter, and similarly, 34% growth year to date to $927 million as compared to the prior year period. And as our strategic growth flywheel continues to spin, we're generally satisfied with the underlying trends we're observing in our portfolio. While we are seeing some of the elevated Medicare Advantage cost trends that others in the industry have identified, we remain confident in our ability to manage our book. Both new and returning member core performance has been strong, which we attribute to our differentiated tech-first model of care to manage Part C cost trends and identify diseases as early as possible. That said, during the second quarter, we observed some elevated pockets of utilization within supplemental benefits, as well as elevated Part D utilization from IRA impacts. While this did negatively impact our results, we have implemented different initiatives to monitor and manage these developments going forward. As such, we slightly increased our full year 2025 insurance BER guidance to reflect these developments, which I will discuss in more detail later. As it relates to the elevated utilization levels we're seeing within Part D, and as Andrew mentioned, we're keeping a close eye on the impacts from the first year of the IRA changes, and we will continue to diligently monitor any evolving trends that we're seeing here. Moving to SD&A, we continue to drive operating leverage and efficiencies in our business amidst our strong growth. Adjusted SD&A as a percentage of total revenues improved to 17% this quarter, a 280 basis point improvement year over year. This demonstrates our ability to gain operating leverage amidst increased variable and growth SD&A costs necessary to support a strong new membership growth this year. More importantly, our result is net of our continued strategic investments focused on stars, quality initiatives, further improving our home care and Clover Assistant platform capabilities, and further accelerating the reach of CA in our MA plan, as well as in our Counterpart Health offering, all while leveraging technology and AI to gain further efficiencies in our SD&A. Our focus remains on disciplined, strategic investments to create lasting value for our members. More importantly, we have sustained our adjusted EBITDA profitability profile in tandem with our strong growth through the first half of this year. GAAP net loss was $11 million this quarter, bringing year-to-date GAAP net loss to $12 million. And this represents an improvement year-to-date of $4 million compared to the same period last year. During the second quarter, in tandem with our continued strong membership and revenue growth, we delivered $17 million in adjusted EBITDA and $17 million of adjusted net income. For the year-to-date period, adjusted EBITDA reached $43 million and adjusted net income is $42 million, both remaining steady year over year amidst 32% membership growth. This underscores the strength of our differentiated growth model, sound insurance operations, and solid cohort management. In addition, our performance this quarter resulted in an insurance BER of 88.4%, compared to 76.1% in the second quarter of 2024, bringing our year-to-date insurance BER to 87.3% and developing in line with our updated guidance for the full year of 2025. As you may recall, last year during the second quarter of 2024, we experienced heightened prior period development that skews the year-over-year comparisons. The year-over-year increase in insurance BER also includes the continued impact of our CA-enabled affiliate entity focused on improving care coordination and health outcomes for our New Jersey plan and members. We continue to push forward with this initiative to drive higher quality and better health outcomes for our members via better care coordination services, unified care management, and a deeper focus on our partnerships with local physicians. Lastly, days in claims payable was 32 days as of June 30, 2025, representing a decrease of 5 days sequentially. This represents continued normalization of our claims inventory from early last year when we experienced an increase in claims backlog as a result of the industry-wide Change Healthcare incident that occurred simultaneously with our back office business processing as a service and MA ecosystem transition. In an effort to normalize our claims inventory since last year, we have accelerated our timeliness of claims payments. We believe that we have now adequately normalized our claims inventory and that our DCP is within expected go-forward ranges. Moving on to the balance sheet, we ended the second quarter with cash equivalents, and investments totaling $389 million on a consolidated basis, with $146 million at the unregulated subsidiary level. During the second quarter of 2025, cash flow from operating activities was $5 million, favorably impacted by our results this quarter, bringing our year-to-date cash flow used in operating activities to $11 million. We expect that our cash balances will remain strong for the remainder of 2025, which will allow us to continue to operate from a position of strength as we invest in our growth model in 2026 and beyond. Finally, we have maintained our full year 2025 adjusted net income and adjusted EBITDA profitability guidance, underscoring our continued business execution, strong intra-year membership growth, and the power of a differentiated model of care. And while our overall outlook remains consistent, we are providing the following guidance updates to reflect the latest developments in our business. We are increasing our Medicare Advantage membership guidance to now average between 104,000 and 108,000 members, reflecting 32% membership growth year over year at the midpoint and continued intra-year growth this year. We are reconfirming our insurance revenue of between $1 billion and $800 million and $1 billion and $875 million, reflecting year-over-year growth of 37% at the midpoint of the range. We are improving our adjusted SG&A guidance to be between $335 million and $345 million. This represents adjusted SG&A as a percentage of total revenue of 18 to 19%, and is an approximate 300 basis point decrease or improvement year over year at the midpoint of the range. This reflects our continued ability to gain operating leverage in our business as we grow. For the full year 2025, we are maintaining both adjusted EBITDA and adjusted net income guidance of between $50 million and $70 million. Lastly, we're updating our insurance BER guidance to a range of 88.5% to 89.5%. This incorporates the underlying trends we've observed this quarter in Part D and supplemental benefits discussed earlier, and notably the impact of our MA membership growth outperformance so far this year. While new members inherently bring near-term cost pressure as we bring them into our care model, we view this incremental membership growth positively as it further strengthens our conviction for 26 and beyond, where these new members will mature into returning members in the future. And lastly, we continue to expect typical revenue medical cost seasonality during the second half of the year, with customary elevated utilization, particularly during the fourth quarter. That said, this is simply normal Medicare Advantage seasonality. We remain confident in our unique care model and are focused on empowering PCPs with technology to identify and manage chronic diseases as early as possible to effectively manage costs amidst broader industry pressures. In summary, we're executing well on our strategy this year, achieving strong Medicare Advantage performance with above-market growth and sustained adjusted EBITDA profitability year to date, which we believe firmly positions us for continued success in 2026 and beyond. We remain confident in our trajectory for the following reasons. First, as Andrew mentioned earlier, we're confident in the growth path ahead, and while not all market plan data is available yet, We have reason to believe that this will be another strong membership growth season for us. Our underlying financial performance allows us to continue to invest in quality and affordability for our members, fueling our growth flywheel, as well as continued investments to expand the reach of Clover Assistant to better manage new and returning member cohorts. Second, we're continuing to prioritize returning member retention in our 2026 bid strategy. We expect the unit economics of our large cohort of new members added in 2025 to significantly improve into 2026 as returning members. And we also expect a continued favorable impact from further improvement in our year 3+ returning member cohorts. Third, in 2026, we will increase to a 4-star payment year for our PPO plans, which brings financial tailwinds that will favorably impact our results as 97% of our members are currently enrolled in a wide network PPO plans. Fourth, we expect a compounding favorable impact from the CMS final rate notice announced earlier this year that affects the broader industry. Although this is particularly additive to Clover, given that we're moving from a 3.5-star payment year in 2025 to a 4-star rating for payment year 26. Lastly, we believe that there will be an incremental impact from our efforts to gain operating leverage via our initiatives to optimize variable, fixed, and growth SG&A costs. By leveraging this year's momentum and targeted investments in our care platform, we believe that we are strategically positioned to meaningfully increase profitability, drive strong growth, and truly unlock Clover Health's full potential in 2026 and beyond. Now, I'll turn the call back to Andrew for closing comments.
Thanks, Peter. In conclusion, we have delivered significant growth this quarter amidst sustained adjusted EBITDA profitability, clearly executing our strategy. Our differentiated tech-first care model is consistently delivering value for members and enabling us to effectively manage costs and drive our strong performance. We remain confident in our full year 2025 performance, and we believe we are strategically positioned for accelerated growth and sustained profitability, unlocking Clover's full potential in the future. With that, let's open it up for questions.
Thank you. We will now be taking questions from Clover's research analysts. At this time, if you would wish to ask a question, please press star 1 on your telephone keypad. You may remove yourself from the queue by pressing star 2. In the interest of time, we ask that you please limit yourself to 1 question and 1 quick follow-up. We will now take our first question from Jonathan Young with UBS.
Hey, thanks for taking the question here. I guess to start, the MCR, BER came in above kind of expectations here. I know you called out SUP and Part D, but within the context of your raised guidance on the BER, how much conservatism do you kind of have embedded in there, and how much visibility do you have into how that trend will develop in the back half of the year?
Yeah, thanks, Jonathan, for the question. So the increase in the BER guide for the full year is mostly related to Part D and supplemental, mostly actually dental. So that's a positive for the members. We have initiatives in place to monitor this go forward. And then we believe there's some relief as well on the Part D pressure from the IRA as we go into 2026.
Okay, and then within the context of what you saw, when did this pressure kind of start emerging? Was it in the earlier part of the quarter, later part of the quarter? And then how much of this did you actually capture within the context of your bids for next year? Just given it does seem like a fairly sizable step up here.
Yeah, I think that, as I mentioned in my comments, this is Andrew, especially on the Part D side, one thing we've been tracking as we go through the year is that this is the first year of the IRA. So tracking against the model is something that's new across the industry, I think. So we did look at that, when we were pricing into the bid. I think you can see that. I think a lot of people in the industry did that as well, as reflected by the fact of the variability and the increase in the Part D direct subsidy that came in for 2026. So I do think that across the industry, that higher Part D costs are being factored in as we start to look and rationalize that trend from earlier this year into our sort of like baseline models.
We'll go next to Matt Hewitt with Craig-Hallum Capital Group.
Good afternoon. Thanks for taking the questions. Maybe first up, you've increased or showing improvement in your SG&A or adjusted SG&A, and I'm just curious, what are the drivers for those improvements? Are you kind of holding back on some of the hiring, or are you finding some new efficiencies within the model? Any color there would be helpful.
Yeah, Matt, thanks for the question. Yeah, so mostly cost efficiencies. We've started a company-wide cost initiative to really rationalize the price and volume terms we get with most of our partnership contracts. Now that we are growing well above the industry, and we're estimating that same growth also to remain for the next couple of years. So we are a very attractive partner. So a lot of that also comes from term renegotiations with partners.
Got it. And then maybe kind of a separate question here, but what kind of response have you been getting from the COPD white paper? Is that something that you can replicate? Are there other similar types of papers that you can publish that kind of highlight the benefits of using CA and kind of driving incremental business?
Yeah, definitely. We're very proud of the papers that we're putting out. We obviously, COPD just came out. We had CHF come out maybe about a month, I think, or two ago. Our flagship paper on CKD came out, I think, last year or the year before. We plan to keep producing this material, and we think that Clover Assistant use is definitely in our data shown to be, as we can see in the white paper, is correlated with better earlier diagnosis, management, care, total cost of care. You can see that in our HEDIS scores, which remain one of the top in the country. There's a lot of these data points which we're very, very proud of. It also flows into how we're talking about the offering in the counterpart context as well, where we point to these results that are being driven by our technology with our own plan, and it's something that we can bring to other plans in other markets.
Excellent. Thank you.
Yeah, of course.
Once again, if you would like to ask a question, please press star one on your telephone keypad now. We'll go next to John Penny with Canaccord Genuity.
Hi, John Penny on for Richard Close. Thanks for the questions. So going back to the BER, is the elevated cost trend you're seeing like kind of more localized in that like kind of newer cohort, or is it pretty broad based? Is there any differences in geography there, or is it again pretty broad based?
Yeah, this is Peter. I'll answer that question. So the cohorts are, we want to be sure that message is clear and lands. The cohorts in our unique model, Tech First model, are performing as expected in line. So for Part D and for supplemental, we don't see a specific split or between new and returning members. So returning members are definitely improving from an MCR and BER perspective as expected.
And I would also add in there that, as we said in our previous commentary, as we model out parts, especially the Part D side of things, which was in my section, this is the first year. We are still figuring out what the baseline models look like. The direct subsidy will increase going to 26. So as Peter mentioned, like I think there's reason to believe that any pressures we see there will be appropriately priced in industry-wide going into next year as well. And we are also, making sure that we keep an eye on supplemental benefits throughout the year.
Okay, great. Thanks. And then also just to touch on like the competitive landscape and the upcoming AEP, is there anything like different that you'd call out on how your competitors are approaching this year going into 2026? Are they like, maybe pulling back a little bit less than they did last year, or anything you would call out on any differences in the competitive landscape compared to last year?
Yeah, for sure. I think that obviously we noting that cost trends like within managed care in general, within even Medicare Advantage, there's been a lot of motion this year by the national players. The way that we see it is that the products that they're most pulling back, well, all of them pretty much are pulling back to some extent. Where they're pulling back counts, and where they're pulling back is generally within that PPO wider network where they struggle to deploy their existing managed care capabilities. And I think that's an area where we are very strong based upon our technology from the counterpart side. So we feel good in our core markets. We feel that if people are pulling back, they're quite likely to pull back within those same markets because those are challenging for the same reasons that they're good for us. So that's why within our commentary, we said that while we don't have all the data yet, we feel like we're likely to be very well placed into this coming growth season.
And I would add to that as well, to point out again, next year, 2026, is a 4-star payment year. So that's also a financial headwind allowing us to grow.
All right, great. Thank you.
And a final reminder was star 1 if you would like to ask a question. And that will conclude the Q&A portion of today's conference. I would now like to turn the call back over to Andrew Toy for any additional or closing remarks.
Fantastic. I want to thank everybody for joining us today. Thank you for taking the time and for your questions. Truly value everyone's interest in Clover Health, and we'll be speaking with everyone again soon. Thanks again, and enjoy the rest of your evening.
Thank you. This concludes today's Clover Health second quarter 2025 earnings call and webcast. You may disconnect your line at this time. Have a wonderful day.
All right, ladies and gentlemen, let me go ahead and stop the share of the screen here. We're going to talk about some good stuff right now. Okay, we're going to do the analysis. I'm going to go ahead and do my theoretical academic intrinsic value calculation based off of some calculations here. But very quickly, I just want to call this out. Let's see here. So as of right now, we have about 2,143 people watching this live, about 1,711 people from Twitter, and about 432 people on YouTube. That is literally insane, right? So for all those folks out there, thank you for supporting the mission of the channel. And with that said, we're going to go ahead and do some research now, okay? So with this, let's go ahead now and go back to what we were saying here. So a couple good and bad. Well, looking at the price of the stock, it looks like it dropped all the way down to around 247. And then all of a sudden it went back up 11%. So unfortunately, a lot of retail investors probably sold, and maybe you got some day traders coming online. But I want to basically point out something. Institutional ownership shares went up to 27.01%. I expect them to go up more than 30% on August 14, I believe, or 15, when they all these a-hole institutional investors have to report how many shares of Clover they bought. But institutional ownership has increased now. It's at 27%. It's going to be more because we still have BlackRock to integrate into this, and then other ones that have bought in. But what I find interesting is the Bank of New York went ahead and basically doubled down and increased their ownership of Clover at $3.46. So they are buyers at $3.46. Let me go ahead and share the screenshot for you. So Bank of New York purchased about 1.1 million shares of Clover. That's about a 1,000% increase, more than 1,000% increase. And they bought at $3.46. So unfortunately, as retail investors sell, especially in the $2 and whatever cent region, you're going to have institutions come online and they're going to basically, take the shares. And it's okay. It's good to get these, folks out, bon voyage, right? It's good because these are the people that are just emotional. So let's get them out. Let's filter them out. Let's push them back to the bottom 50%, right? And then ultimately, institutions are going to come slowly, basically, gobble up the shares, right? So, okay. Now, with that said, let's go ahead and do some math here. So, A couple things I want to talk about. They did mention something that I talked about, which was ultimately the bad. The costs are going up, which is why I started calculating the medical cost ratio. And the medical cost ratio went up approximately 3% this quarter. That's a big change. I think they were guiding to become profitable this year for this quarter. But the problem is the costs went up. The question is okay, costs go up, but I thought the Clover Assistant can be protective amongst these costs. Are costs going to continue going up or not? So it's something that we need to look into, because what happens if MCR starts to go up to 83, 84, 85%, right? Not BER. MCR is a different calculation. So based off of this here, oh, you guys want me to? Okay, fine. We'll go ahead and just we'll go ahead and remove. We got somebody asked to remove Laz. Okay, there you go. Laz is gone. All right, that's fine. I don't like to remove people, but it's fine. Whatever. All right, so we can focus. Let's focus. Okay, first off, there's a lot of crying sissies right now. A lot of crying. Oh my God! Right? So many people crying right now. Look. Right? It's like, oh my God. It's okay. Let me wipe your tears. Come on. Come here. Let me wipe your tears. Oh God, it's okay. It's okay. It's okay. It's okay. Oh. It's okay. Come. Hold on. Just give me 1 moment. Hold on, guys. Okay, I'm back. I got a little Mac, nice little microphone. Let me wipe your tears. Oh, good. Come here. Come. It's okay. Let me wipe your tears. Oh, okay. All right. Are you feeling better, guys? Be a man, okay? Be a man. All right. So enough joking. Let's let's talk some math, okay? All right. Okay, guys. So, all right. Medical cost. Medical costs have basically gone up, and they're starting to suffer industry trends that others are facing. The question is can the Clover Assist, like, this is a negative on the Clover Assistant, because, well, it's true that the Clover Assistant still has medical cost ratio, leading medical cost ratios. Why are the costs increasing? What is that isolation effect, and can Counterpart deal with it? So that's something interesting to see. Now, historically, if we look at BER in relation to MCR, I want to say it's around 5 to 6 differential. We'll check. We'll check about this. But the big thing that I've noticed, the words that he used, okay, is let me bring it up here for you guys. Okay. All right. So he said, Andrew Toy said they want to grow 2026 EBITDA profitable, but he said 2026 EBITDA. He didn't say 2026 net income. So based off of these industry trends, Clover may not be profitable in 2026 off a net income basis. Now, I could be wrong. It's hard to extrapolate this, but Clover may not be net income profitable probably until 2027 and beyond. They probably still might be EBITDA, right? Probably might be EBITDA in 2026, because they did not say, and again, why would he say we're going to be profitable net income? because there's some uncertainties happening right now. Okay. And he said that 2026 may be a known turnaround. And there's a known unknown here. So the big thing here that I'm looking into is right now, and this has been more important more than ever, is we need to look at United Healthcare and all these other ones that are in the Medicare Advantage market to ultimately see when their business turnaround happens. Because once we start seeing them bottom out, then things can basically start moving up on the Medicare Advantage side. But the fact of the matter is that, are these costs going to keep rising up? And is the MCR for Clover end up going to be 89, 90%? Because if that's the case, then there is no differentiation with Clover Health. And the biggest bear case here, is if that's the case, and if this continues, and it's not fixable by the differential that they believe, where the 700 basis points is in the second year and the 1,500 basis point happens together in the third year, then that loses the competitive advantage of Clover Health, right? So that's a big deal, right? It's a big deal, okay? So that's something that I'm looking into, okay? So if I was to look at the Medicare, like the MCR, I'm curious to see what the MCR was for last year. And to do that, I need to go here. I'm going to remove all this. Oh, wait. No, I don't want to remove that. Let me just, this is cute. I don't want to remove that. We'll push this here. I want to look at Q2 last year. Let's go here. And I want to look at the premiums earned.
Premiums earned.
Good. And it's interesting because they don't show us the premiums earned for the full year, which is quite interesting. The reason why they show us here is because it makes them look a lot better. And it shows the MCR to be a lot better than what it is for the 3 month. That's probably why they put it in there, just to soften the blow. But I don't like when companies soften the blow. I like them to, be honest. But they give more data. They don't remove data. If they remove data, I would be more upset. But if we take this here, because they usually don't, they didn't mention 6 month end here for Q2 2024. Am I correct? Is this Q2 20? No, this is the first quarter. Sorry. This one here, Q2 2024. Let me double check. Maybe I'm wrong. Never mind, I am wrong. They do mention 6 month end. So I don't see anything. I don't see anything wrong. Again, I'm trying to have an objective analysis here. So if we go ahead and do this,
349,900.
and if we go to 349 million, that's the premiums earned. The net medical claims incurred
248,947.
is 248 million. Divide that, you get a medical cost ratio
0.7097.
of 70.97. So we'll go like this. We will remove this, and we'll go like this. So here it is. So this is not good, which they mentioned. That's good. Again, that's what I was touching on. I was trying to figure out what happened, because there is a change in the fundamentals. There has been a change in the fundamentals. Okay. So from Q2 2024, we went from 70.97% MCR to Q2 2025, a year later, to 80.45% MCR, because you got to compare quarter to quarter, which is a differential of a 9.48% increase in medical costs. Now let's go ahead and look at Q1 2024 MCR. Q1 2024 MCR. We're going to go here. And we're going to divide it by this one here. So Q1 is 77. Okay. So there's that, which is put this there, turn it into a percent. So I'm just going to put this here. So from Q1 2024, they were at 77.5%. And then Q1 2025, they were at 77.
77.35%.
So from Q1 last year to Q1 this year, they actually surprisingly went down.
0.15.
Decrease in medical. So they actually did good. But for some reason, from Q2 last year to Q2 this year, they went up almost 1,000 basis points. Pretty much opposite, right, of where you want to go. And this looks like they're saying because of new members. And they also said returning cohorts. I don't know why. What is that, right? So if we go ahead and look at this graph here, the table, new members usually don't have a MCR that's helpful. There's no differential. It's usually by year 2 and year 3, we start seeing a differential drop. So what I want to know is these new members that they got, is it increasing because of the new members, or is it increasing because of the old members? If it's the old members, then that means Clover Assistant may not work. You see how you starting to get chatters like this? Maybe the Clover Assistant may not work. Maybe Counterpart doesn't work, right? So that's what I'm looking at right now. But as a scientist, what is the change here? What is the delta? The changes, they're growing, and that's the only variable that changed from last year to this year. They're being paid 3.5 stars. Nothing's really changed. Maybe the members, they're just going to the doctor more, or maybe the members that they picked up are spending a lot more. So it seems to me as if I was looking at this, I think the new members may be the change in differential here. And if that's the case, then as they enter the system, then they will slowly start decreasing this basis point increase. Now, with that said, now we have to do the calculation now for Q3 2024 MCR, Q4 2024 MCR. We have to see kind of what that is, and I guess we'll add 9%. But wait a minute. What happens if like this 80% MCR from the 70% last year goes up even more? What happens if these patients in this cohort keep going back to the doctor and they keep essentially having to have increased spending. Well, if that's the case, then okay, then MCR could go up even more. But they gave us a guidance, and that's them kind of hinting kind of where this would go. So to do that, I'm going to go to the fourth quarter, and I think the fourth quarter has some good information of last year. And the fourth quarter, I think did they give us an MCR? Yeah. So fourth quarter full year MCR. So here's the MCR for the full fourth year. Was 75%. The BER was 81%. I'm trying to figure out the differential, the difference between the insurance BER and the insurance MCR. To find the differential, we have to do some math. So I'm just going to put some more math here. To do the differential, we have to take the BER subtracted from the MCR, right? And when we do that, we take 81.2%, which is the BER, subtracted from the MCR, which is 75.1%.
75.1%.
And when you do that, you get a differential of
6.1.
6.1%. Okay? We get a differential of 6.1%. That means if we look at their guidance, which is what they gave us for the second quarter, their guidance was here, and they said 88.5 to 89.5. What I'm going to do
88.5%, 89.5.
is I'm going to add them together, and then I'm going to take the midpoint, which is 89% BER. So 2025 BER guidance there it is. Was 89%. And we said that the differential for MCR between BER and MCR is 6.1%. So what do? 89 minus 6.1%. So now the expected MCR now
82.9.
of MCR is 82.9%. 82.9%. Versus before we were thinking like 81, 80, right? 80, right? So that's kind of what we're at right now. And I like MCR better than BER in my opinion, because it's kind of helps me compare to other insurance providers. Okay. So MCR is now 82.9. It's actually pretty good for us, which means it means they don't have to give more money back to the government in the beginning half, which is fine. It's a little game they can do. Increase it, and then it'll cause their flywheel business model to increase, because then year 2, they'll drop 700 basis points, year 3, 800 basis points, and the cohort before will do 700. Again, it's a flywheel. But I still want to know now what the MCR is going to be for X, Y, and Z here and here. But what they did now, so now we did this. Now, what I want to know is the 6-month end MCR of 2025. To do that, we would need to go to Q2. This is the first quarter. This is the second quarter. So the 6-month end is here. So we take this number here,
926,732.
and we divided by the medical claims incurred, which is here,
731,434.
and we divide that out, we get an MCR
0.789.
of 7.89%. So what this tells me is that the MCR is going to end up going up higher. That means costs are going to go up in Q3 and in Q4, which means that we might get a less negative note. Because before we got an improvement and we went from negative 19 million to negative 1.2 million. Right? Negative 19 million and negative 1.2 million. So we had an improvement, right? But then now it's changed. We went from an MCR of 70. Hold on. Let me finish my statement. So we went from negative 19. So let me show you what I'm referencing, because most people don't have photographic memory. So if we go here and use our stock terminal, we go to net income. Okay. Q1 2024 went from negative 19.17 million to Q1 2025 was negative 1.27 million. This will update once they submit their forms to the SEC, then it'll update, right? But you could see there was an improvement, a remarkable improvement of like a lot. That was because the MCR, it went from 77.5% in Q1 to 77.35% in Q1 like 2025. So it improved. But now you're seeing an increase in MCR from Q2 2024 of 70.97% to 80.45% in Q2 2025, which essentially took us from being positive $7.4 million in Q2 2024 to being negative $11 million in Q2 2025. Which means that Clover, I'm expecting them to be more negative in Q3 and in Q4. The question is, how negative? Well, we saw a big jump. We went from, if we go from 7.41 million down to negative 11 million, what's the change? That change in delta is $18.41 million. So based off of this, if we take this delta and multiply it by 2, and again, I could be wrong here, we should see negative 36.82 million added on to these two numbers here.
9.15.
9.15 plus 22.09 plus their 11 million. It was 11 million, correct? That they were negative. That's 42 million
42.24.
plus $36.82 million. So because of this,
79.06.
My new expectation for them, net income for 2025 is going to be negative 79.06 million, which is a lot worse than what we had last year of 43 million. Now, if they're able to be less than this, I'll be happy. But I don't think that they're going to be able to beat out because it doesn't make sense. They weren't able to beat out Q2 2025, which was their most profitable quarter in Q2 2024. They made $7.41 million last year, and this year they lost $11 million, negative $11 million. That's a differential of $18 million, which means that Q3 and Q4 is essentially going to be, even more negative. Right? So there's that. And what I find interesting, I'm going to look at the stock price right now. It's $2.62. It has dropped a lot this year. The question is it at fair value or not? We're going to go ahead and do the intrinsic value right now to see where it could be at. Before we do that, I'm going to go to the restroom real quick because I've been here for a while because I made a live before this. So, and this is without 4 stars. This is with 3.5 stars. But this is kind of the work I have. Again, we're just kind of working in this document. We're going to continue doing due diligence. We're going to keep breaking it down. We're going to keep massaging it. But I want to go to the restroom real quick. And I will be back. Let's put on this one here. All right, guys. So I'm back here. Let's see here. Mic is good. All right, good. All right. So now, let's see here. All right. So now I want to calculate Q3 and Q4 MCR real quick. So let me go for 2024. So let's go ahead. No. Let's go ahead and do this one. I'm just going to calculate all these MCRs out right now. I mean, technically, don't they calculate them for us? Because they end up doing it anyway. So they calculate them here.
78.0%.
So they do it because they stopped doing it this year, but they used to do it before. So this is actually going to be a lot faster. So 78%. Uh-oh. 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 Uh-oh, guys. Uh-oh. Okay. Not good. All right. Let's look at Q4 MCR. Let's see. Q4. Yeah, interesting. This one's 73. It's kind of weird, isn't it? It's just quite interesting.
73.5%.
Okay. So there's that. So watch this. So what I'm going to do now is I'm going to do projected Q3 MCR. And I'm just going to do the differential, of what we just experienced, which is 9.48%. So if we take 78%, add it to 9.48%, and it could be even higher, plus or minus 2. And if we add 78%, because Q3 2024 last year was 78, they had more costs. That's about 87.48% MCR, which is like over a 90% BER, right? But they did say it should be below. So I don't think it'll be that much, but we'll just be bearish, right? And now we're going to do projected Q4 MCR. You see, this is what happens. This is what separates the cattle from the wolf, right? Now everyone's like, oh shit, I need to do some DD, right? So then now let's go here, go 73. Let's add this. So that's about 82.98%.
82.98.
So there's that. So now let's go ahead and add all these up and let's see if we can get to the expected MCR of 82.9%. So now let's sum. Let's do this. Sum projected MCR 2025. Okay. So if we add them all together, 77.35 plus 80.45 plus 87.48 plus 82.98. Let me make sure I got the numbers right. 87.48. Okay, and we divide that by 4. You get 82.15.
82.15.
So we'll call that 6%. 82 point, which is right next to our expected MCR of 82.9%. So I'm expecting next quarter's MCR to be around 87%, which means the projected BER would be a 6.1 differential on average, 87.48%, plus the expected the projected BER, which was, we said, 6.1%. So I'm expecting BER next quarter for the projected Q3 to be 93.58%. And I know they said they're going to be in between the other 88.8 to 89%. But that's the average of all 4 quarters. So now let's go ahead and let's look at the projected one for Q4. I'm going to remove this. And let me just kind of change this here and call this Q1. I'm going to remove this. I'm just kind of removing it, setting it up. They already gave us these, so I don't have to calculate these ones. So let's see. I'm going to kind of remove all this here. This is first quarter. BER was 86.1.
86.1%.
Sorry, that goes here. And then now we got to look at the first quarter. Wait, yeah, sorry, second quarter. And this BER, what was this year's BER? Did they even tell us? No way. Okay, good. Yeah, you better tell me. I thought they're hiding numbers from me. I was about to get pissed, right? All right, fine. No, they did not. They're being honest. So here it is. You see how the BER is 88.4%, you see? And last year was 76. So what happened? That's over 1,000 basis point differential from BER. So about 88.4.
88.4%.
So that's there. Okay, good. So there's that. Okay, so there's that. Now what's the projected for Q4? We do Q4. We add 6.1. That's going to be 89.
89.08.
So now we're going to add all these BERs together. Clover's estimate. So this is Clover's estimate, which was here. This is their estimate. You see how it went up a lot? That's a big increase, right? And so this is Clover's.
88.5%, 89.5%.
Okay, so this is what they've given us. And now we're going to calculate 2025 sum projected BER. And to calculate that, we're going to calculate all this 86.1 plus 88.4 plus 93.58 plus 89.08. To do that, divide that by 4. That's 89.29.
89.29.
There it is. 89.29, which falls right in line with their projected estimates. So this proves to me that my projected MCR is correct. This is good. Excellent. Like I'm more happy because I was able to back calculate it by finding the difference. And then I was able to go ahead, do the differential 6.1. And then I went ahead and I was able to figure out that it falls right in line with their BER. Excellent. Good. Now, so there's that. Okay. So we talked about this. And now, do we really need to know the 6-month end MCR versus the 6-month end? I mean, we already know costs are going up. So I guess we can do the 6-month end MCR for 2024. And we'll see the difference of how much it increased by. So to do that, you would need to go to Q2 2025. Sorry, 4. Q2 2024. We go here. And what we do is we take this number here
691,622.
and we divide it by this number here.
513,509.
And we get this number,
0.742.
which is the MCR for the 6-month end. So what we can conclude is MCR increased by 4.7%.
4.7.
Year over year. Okay, so let's think. Okay. So now let's do another calculation here. Total 2024 MCR for last year. To do that, you would need to go to Q4. And we would need to go all the way down. Was 75%.
75.1%.
Okay. And now MCR is 74%. But we haven't hit third quarter yet. So my projected, so because I'm trying to figure out the differential here. So there's a 4.7% differential. And if we add 75 to the 4.7% differential, that gives you 79.8, which we know that's not correct because MCR for Q3 is going to be hell, which is going to increase it. So MCR now, the difference between, because that's my projected. So the reality here is, since this is my projected, MCR is going to go up by 82.16, and it could be more, but minus 75.1. MCR is going to go up by 7%.
7.06.
7.06%. It's going to increase in 2025. I'm going to put ... However, in 2026, MCR is going to get forget this. We're going to get 5% boost because of the 4-star rating. And we're going to get an approximate 9% boost from CMS because of the recycle that they did, which should give us around 9 plus 5, around 4, was it 14? Equaling a 14% differential, which is easily able to gobble up the 7% increase in MCR. Okay. Okay, that makes sense. Okay. But here's the problem. What happens if they grow again in 2026 and they add another 7% of medical cost ratio increase? Then this 7% plus another 7% next year is going to gobble up this 14% increase. So we're going to basically be where we're at right now with higher revenue and still being unprofitable. The only way this would work is if this 7% goes down. How is the 7% going to go down? Well, what happens during the second year of Clover members? How much do they go down by? 700 basis points, which is equivalent to 7%. Are you seeing the math here? So what this basically means, you see B-Rad Cooley? You see what I'm saying? So there's some funny math going on here, and it's they've gotten pretty lucky, I would say. So if they're Clover, now this is going to be the magic. This is going to be, because I remember. Okay, hold on. Let me go back. You remember how I told you how once I get more data, I'm going to be able to extrapolate knowledge and be able to really get in there? Well, I'm getting to a point where I'm 80% there, where I'm about to determine if this is going to be a good or bad investment. Next year, I'm going to see, and they've already proven their counterpart given the past couple of years, but now the industry's facing heat, and they are too. But I can't isolate, is this heat from their old members or heat from the new members? Well, these new members are new members, but next year they'll be technically old members. This 700 basis point at Clover, if you're watching me, okay, the 700 basis point increase, so decrease from MCR, I'm going to be effectively able to back calculate this, and I'm going to see, is this 7% going to be removed in next year's Q2? Because if it doesn't, and if it stacks, and we are where we are now, then CA may not work for these other newer members. So there's that. Okay. So based off of this, year one, there is no improvement, which we saw. We're increasing cost higher than what they expected. Year two, 700 basis points reduction. Year three, 800 basis points, which saw a total of 1,500 basis point reduction. The only way they can mess up the data for me is if they grow more than 37%. If they grow 40, 45%, then I'm going to have a harder time isolating this effect, because this negative effect MCR down pressure of 7% will be washed with the data, and I'll have a hard time isolating it. And I'm going to have to think of some clever math to isolate this. But better yet, 4-star rating increase 5% next year and 9% for the CMS recycle phase for a 14% increase. So there it is, guys. So this is kind of what I'm looking at. I'm expecting BER to be 93%. So I'm expecting the next earnings report to be pretty bad on the BER side. So I'm expecting them to be very negative, and also I'm expecting them to be very negative also in Q4. Now, with that, I'm not going to be saying this online. I'm going to be saying this to my lifetime access members. But with that, I'm going to be calculating the intrinsic value. And if that's the case, there's going to be a lot of gamblers for Clover. And this is where I could play now covered calls and cash secured puts. Because if we know what the value based off of what they've given us from a theoretical academic exercise, if we know what this means, then it could be we may have a stagnant year. But other retail investors don't know that. We're going to calculate that, and we're going to see, right? The only other reason where we will get screwed with the covered call is if they announce counterpart health revenue. If they do that, then all shit hits the fan. That's it. But I don't expect them to have revenue, and they're not going to announce Humana. They did say a large. So now let's talk about the other good news. Andrew Toy said that we are helping a bigger insurer. We know that I know that you know there's a subdomain for counterpart for Humana. And if you go to Humana, there's a subdomain that. So within, and I said this on Twitter, I don't expect any money from Humana until 2029. Okay. Now, again, it's unfortunate because a lot of folks can't wait that long. And my recommendation is, go to Vegas, right? But this is a long-term investment. And what I'm seeing right now is they have these short-term increase in costs. And from what it looks like is these costs are increasing because of the new members. And right now, they're on front and center trying to figure out how to stay ahead of it. So there's that. I'm going to copy this. And I'm going to go ahead and put it here. So I have it here, and I'll keep adding on to this research. But what I wanted to do now is I wanted to shift gears to intrinsic value. Okay, so now that we have this, now let's go all the way down to the cash flow statement. They got, again, it's kind of funny. They just got and added $33 million from their investments. I'm sure they didn't want to sell their investments. I'm sure they don't want to sell it, but they got it as a defense. Why? Because I think that they're going to end up losing, like what we said, I think they're going to end up losing around whatever $1 million, $79 million this year, based off of this increase in medical cost. But we'll see. Let's see here. So now, because their cash went up from last quarter, I know this is the 6-month end. I'm talking about Q1. Now let's go to the statement of cash flows and let's figure out the percentage. So I want to know the percentage now. So we said that this was cash flow positive. So how do we figure this out? Let me think. How do I figure this out? So how do I calculate what cash flow? And they said that they're going to have strong operating cash flow. Now they might end up having, I don't know, like last year, 19 million of free cash flow. But we're going to be conservative. We're going to say 0 for this, which adds money there. But because they went, so if we do that, let me do the math here. If we take $16 million, subtract 10.885. So I'm going to do new notes now. So Q1 and Q2, they have, well, actually Q2 is 5 million. Well, actually, no. Let me go ahead. Q1 and Q2. What I did is I removed 16 million and added it here. By doing that, you get 5.8 million. Okay. Now the question is, since they got 5.8 million for Q2, are they going to get more in Q3 and Q4? Well, Q4 they were negative, so they did say they're going to have strong cash flow from operations. So to answer the question, so we can get some accuracy here to answer this question. You see how long due diligence takes? I mean, this is what it, I mean. This takes a long time, guys. Right? This takes a long time, right? Okay, so let's see this really quickly. So let me think. Q1, okay, Q2, Q3. Let me think. Q3. Yeah, let's look at. Ooh, I want to say. No, that's silly. No, there's a better way of calculating this. There it is. Okay, I'm just thinking. I gotta think this brain. Okay, fine. I got it. All right. So so what we're gonna do now, I got it. So 79 subtracted from 63.4 million. So to do that, if we remove unpaid claims from last year, they made technically $16.2 million in real operational cash flow last year. So now we're going to go ahead. We're going to put this there. We're going to take this.
Q1/Q2 2025, 5.85 years.
We're going to remove this. We're going to convert this into decimal here. That turns into a 5. So what percentage, check this out. What percentage of, and again, we still don't know the extent of this, so it could be a lot lower because technically cash flow from operations for Q3 is going to be hell. So it could be a lot worse, but based off of this, what I'm getting, we can say 5.85% or million divided by 16.25. So about 36%.
0.36.
So 36% of last year's real free cash flow or OCF is this year's OCF. Okay. So now that we know that, we're going to go here for last year's full year cash flow. And we are going to, and again, this is going to be a big problem here because I think the loss is going to be a lot this year, but we'll see. We take 82 million and we don't have discontinued operations anymore. We take 82 million. We're going to subtract this net. Where's the unpaid claims? Right here. We're going to subtract this.
19,296.
That'll give us 63 million. Okay. And if we take 63 million and if we multiply by 36%, that means this year, the free cash flow for Clover is going to be 22 point. Let me see here. Yeah, 22.74 million. I'm going to go ahead and I'm going to take half of that, which is very bearish. It's not going to be half of that. And then there it is. Oh, you're close. Good job. Yeah, and you saw the math I'm doing, right? Yeah, excellent. You said 23. Damn. Did you do the same calculation? Good job. Good job. B-Rad Cooley. All right, excellent. All right, good. This is educational. Absolutely. That's wonderful. So then now what we're going to do is we're going to go here. We're going to open up our handy dandy intrinsic value calculation. We're going to go ahead and put CLOV. Okay. We're going to do the upper bound. We're going to do the upper bound now. Upper bound is 22.74 million. We're going to do 37% because that's what they're growing at. Like that's their guidelines. And when we do that, we get a recession case of 155, a bear case of 335, a base case of 466, and a best case of 694. I'm going to take the screenshot of this. Okay. That's the most bullish Screenshots, not there it is. So that's the most bullish that we'll see. I don't expect them to go higher than this. There's no way in God's hell, right? No way in God's hell. Again, just from an educational perspective. Okay, so now let's add last year's net revenue of 9% plus this year and divide by 2. That's 23%. So this is more at reality. So there it is. Recession 69 cents, bear case 135, base case 182, and best case 261. $2.61. Okay. Now, right now, CLOV is trading at $2.55. Okay. So this is the low end of the 23%, but we know that they're growing 37%. And I think they're going to grow more. So I think the 23% is not the best way. Now we're going to go ahead and do the 11.37%. Sorry, free cash flow. And we're going to grow them 37%. Okay. I'm in this camp. Okay. Okay. This is without SAS. I think anywhere recession case 78 cents, bear case 167, base case 233, and then best case 347. I think we might even touch base case. I don't know. We'll see. But the best case is 347. Right now the stock is at 255, so that's a 36% increase. So it seems reasonable. Now let's say if we go to 23%, then we could see $1.31. But I don't think that's possible because of Vivek buying at $1.80 and I think another buy in $1.20 to $1.30. So I think this here 37% is kind of where I'm at. And I'm expecting them to do about 11.37 million of cash flow this year. Not a lot. Or 22.74 million of free cash flow. If they end up pulling a Houdini and it's 22.7, then great. But the beautiful part about this is that I'm gonna take advantage of this because now I'm gonna end up a lot of folks that don't watch the channel that they're not gonna understand this stuff. So this is gonna be pretty good for folks that find other avenues to rent out their shares for insurance. So there it is. Yeah, and my average is around there, like around 150, 160, right? Off of both accounts. So that's good. So we're sitting great. So that's good. So there's that. And in terms of CLOV, institutional investors are increasing. We see it here. It's going up. 27% ownership. But that's it. You know what's interesting? It's crazy because right now we have about 2,109 people listening on X, and we have 224 people listening on YouTube with a total of 2,333. Holy moly. How is Open Door doing? I haven't checked. Whoa. It dropped down to 198 all the way down to a low of 180. Well, it looks like it broke in the downward spiral. So, and they must have not been profitable as what Sandeep was saying. And I don't know. I haven't looked at it yet, but that'll be a good update to do. But there it is, guys. Yeah, no, we're still going, baby. We're still going. So that's about it, guys. That's pretty much it. We've done the analysis. This is kind of where I'm thinking. I think this year is going to be a dud unless they release any counterpart revenue. We'll see about that. But this will give me an opportunity for myself. I can't speak for you because I'm not a financial advisor, but I'm just as an American who has free will, I'm going to take advantage of this and get as much as I can. My goal is getting up to around 500,000 shares. As of now, I'm at 440,000 shares. So I'm going to continue gobbling up more, and that's it. We're going ahead and do that. But yeah, so next quarter, I don't really think it's going to be any good unless somehow they're able to manage costs. But I don't think so. And we'll see what happens with the 4-star ratings. And we'll see if the guidance goes up even higher then, and if they end up having the guide higher for BER, it's not going to be any good. But from what it looks like, there is a connection between Humana and Counterpart via the subdomain, which Andrew mentioned on the earnings call that he's working with a larger insurance provider, but he didn't mention who. So there's a lot of retail investors that sold, and I'm sure a lot of institutions right now gobbled up a lot of those shares. And we're going to continue seeing that. Again, guys, you have to ask yourself, why does like Tesla used to be owned by a lot of retail investors, 70, 80% or whatever it was back in the day, right? There's a lot. And then all of a sudden it starts to go down, right? Like when I was in Tesla, it was like another company, Enphase or whatever. And that's what happens. Retail investors sell, and it's okay. It's a part of the game, right? But we need to go ahead, look at the support and resistance on the software, on the stock terminal. We'll go ahead and do it internally from what I see here. Yeah, exactly. You're looking at 200. Yeah, exactly. So this is great. I know where I'm headed, right? In terms of where this is at. There's a hiccup. I need to monitor the hiccup because remember, guys, listen. Okay. There was a time where Clover Health there was a time where Clover increased their growth and they became unprofitable. Okay. That was for the ACO. That was a big no-no. There was another time Clover Health increased their growth, and that was for the Medicare Advantage, and their MCR went up, and their star ratings went down. Their star ratings went down twice. Okay. So as of right now, I think that they're in a different position than they were before because their star ratings are going up. But the goal right now is I need to see what's going to happen to medical costs. As of right now, they're going up because of these new members, or is it because it's the old members and the Clover Health assistant is not working? That's dangerous. That's very, very dangerous. That's a very dangerous mechanism. Okay. But we'll figure this out next year when they give us the numbers for, and especially now the turnaround. If there's a better turnaround, there's a 14% margin. And if there's another rate notice increase, we'll see. But that's kind of what I'm looking at right now. And that's it, pretty much. That's it. So let's see where we're at right now on the after hours market. We are at 253. And we'll see what ends up happening tomorrow. As of right now, we will be coinciding with United Care. So if United Care drops, we will be dropping. As of right now, we are down 8.94%. Given that costs are rising, we are technically down from a high here, already down 40%. But on the year, we're down 8.95. So who knows? Could we go down lower? Could there be more blood on the street? Dun, dun, dun. And if there is, you know what I'm going to do? I'm going to do what I do best. I'm going to eat that meat. God bless you guys. I'll see you in the next one. Wait a minute. So again, I need to re-listen to it again. You're telling me, because it was hard to hear because like his microphone sucks. Peter was saying that it's not coming from returning members. Well, there it is, guys. If it's not coming from returning members, then we're pretty good then. We're pretty good then, if that's the case. If it's not coming from returning members, then okay. That answers my question. Excellent. All right, this time for real. Peace out.